Welcome to the Finance Podcast. The topic of this episode, China, what next? With the speakers Caroline U. Maurer, Thomas Schaffner and Omar Slim, moderated by Thomas Breitenmoser.
Good morning everyone, or good midday. My name is Thomas Breitenmoser. I'm Head of Investment Consulting and Controlling at Complementa, a local consultant, mainly looking after pension fund investments. With me, today we have an interesting topic. We see it also in the audience. China, what next? I definitely think many of you will be disappointed about that, what happened in the recent past. And we all hope, hopefully, for a better future. But to find out if this is really the case, I have three different panelists. First of all, to my left, Thomas Schaffner. Thomas Schaffner is at Vontobel. Then I have Caroline Maurer. She's Hong Kong-based at HSBC. And then I have Omar Slim. And Omar Slim is different to the other two, not on the equity side. He's on the bond side, on the fixed income side. And I think we have the great ability now to have the insight on both sides on the balance sheet structure. Now, I would like to hand over to yourself to give a quick introduction, a little bit more detailed about yourself. Omar, please.
Yes, good afternoon, everyone. It's very good to be here. So I'm based in Singapore. I co-head the Asia Fixed Income team for PineBridge Investment, which is a New York-based fund house. China, of course, is a big part of what we do. We have a presence in China through our joint venture, as well as in Hong Kong. And again, I'm based in Singapore. And I look forward to the conversation. It's very good to see so many of you. Sentiment around China has been quite negative, so it's very good to see so many of you here and share my thoughts on the macro side as well as the fixed income side.
Thank you, Omar. Thomas?
Thank you. My name is Thomas Schaffner. I work for Vontobel Asset Management. I'm based here in Zurich. I'm co-manager of the MTX Sustainable Emerging Market Fund. We also run a sub-fund, which is a China fund. So, of course, managing an EM fund, China is like in the centerpiece of our attention and also of our asset allocation. You might ask yourself, why is a Swiss guy doing this? So we are actually quite a broad team. So we are more than 25 people, with people also based in Hong Kong. And I myself studied in Hong Kong. I also worked in Hong Kong before I joined Vontobel 15 years ago.
Thank you. Caroline?
Hi, good morning, everyone. My name is Caroline Maurer. I'm based in Hong Kong. I head up the Hong Kong, China, both onshore and offshore China investment teams on the equity side with HSBC. So as you probably know, HSBC has a quite big presence in terms of China investment, both on the equity and the bond side. Thanks for the opportunity to have me here.
Thank you. I think to start with, we all had a great experience in the years 2000 to 2010. Then it was quite okay-ish in the 2010 to 20s. And now just the recent time after Corona, and now especially the last 2-3 years, it was really underperforming the China market. Now, are there any sign of stabilization? What's the moment? How do you look at the market right now, Caroline?
Yeah, sure. As you mentioned, last few years we have been seeing significant, challenges in terms of China economy and the markets. So a lot of questions around, where are we going to see the bottom? Are we going to see a bottom soon? I guess we do see some early signs of stabilization. It still depends on both internal policy and external, environment as well. But I think the biggest negative drag on the economy and the market impact was really the property in the last 3 years. And if you look like the property transaction in China last 3 years has halved. So the impact has been quite drastic. I guess this rebalancing, if you like, has happened in a pretty drastic way in the last 3 years. Basically, the previous lead in economic growth drivers on the property has come down sharply, while the things is trying to continue growing is more on the actual manufacturing side, the infrastructure side. So we see early sign of probably property market stabilization to a certain extent at a much lower level. Therefore, next step, what is going to drive China growth will be coming back to consumption and manufacturing, export, which both depends on domestic policy, further loosening or boosting on those factors, as well as the international environment from my standpoint of view. It remains quite fragile, I would say, stabilization, but we at least see early sign of that.
Okay, thank you. Thomas, how do you look at that? I want to stay at the property market, which is probably one of the key drivers of this unhappy performance. How do you look at that?
Yes, definitely. We think that the key issue actually is the property market, and what goes hand in hand with that is consumer sentiment and also the overall mood in China. So the mood is quite depressed. There's some uncertainty also around property, but also job security. And really, I think the key will be for the government to bring confidence back to the consumer and to corporates so they start reinvesting again. There are some green shots. So things now over Chinese New Year have been stabilizing. Some areas we see some signs also of improvement. And also I think what people forget is at one point in time, the government will have done enough. The question is just when is this moment being triggered? So there are more and more measures coming up by the government on the monetary side, on the policy side. There are direct interventions in the stock market. So there are a lot of measures coming. And at one point in time, they will be good enough actually to trigger a resumption in confidence and more business activity on the ground. When you look at the consumer, unlike prior to the financial crisis in the US, the consumer is not geared up. The financial system is relatively closed, and there's lots of cash everywhere. So if you look at deposits at banks, they are at a record high. So they can be deployed either in the property market, either for consumption, or also to invest directly into the stock market. So if you look at China, there are issues, but these issues can be addressed. The market is very cheap. Sentiment is extremely negative. So I'm actually surprised that the room is full. In the last 5 years, I've never seen a full room for a presentation. Most of the time, I wasn't even invited to present. So I think it's a sign that we have a lot of smart investors here. So you buy when things are cheap. Risk have gone up, definitely, but so has the risk premium in China. The question just is, when will this trigger be triggered that confidence comes back? Can be tomorrow, can be in 12 months. The timing is a bit difficult at the moment.
Now, when you say the market is cheap, that means the market is wrong, and you know more than that. So we'll find out if it's cheap for a reason or if it's really cheap. But maybe I just want to stay a little bit on the property market since such a dominant factor. You, Omar, you looked at on the balance sheet from the fixed income part, etc. You're also largely allocated in there, and I think that has quite some impact. He said there's a lot of cash out there. Is that really good news also for bondholders, or how do you look at that situation?
Yeah, I would have a slightly different perspective, I guess, on things. But just to kind of clarify, we are actually not largely invested in China property bonds. We are actually...
The property bond market has changed in bonds from what to where?
We were probably one of the first managers to be very cautious when it comes to China property bonds, and we're quite pleased to say that. I would say the causality that Thomas, Caroline talking about, I would kind of slightly reverse it in the sense that the fact that the China property market has been decimated really is a symptom of something which has happened within China over the past few years, which I think it's not the cause itself, it is a cause for quite a bit of economic growth, underperformance, and so on. But it is the clearest example of the policy shifts that we have seen in China. And I think when investors look at markets, typically there's a view on fundamentals. If you're in the stock market, you look at earnings, earning growth, you apply a multiple. On the fixed income side, you look at the fundamentals, the credit trends, and so on. And of course, these are all very important. But when you look at China specifically, what needs to be a bit different, which is something that I think certain investors missed over the past few years, is that policy really drives market performance. When you actually look at growth rate last year, it was in the low 5%, quite respectable. And this year is going to be a decent growth rate as well. It's going to be lower, and we think that there has some downside risk in terms of economic growth. But economic growth rate in China is reasonable. The issue is that policy has become much more selective, much more targeted, and it has become less supportive of particularly specific markets and markets broadly. And this is in full display in the China property market, specifically and to a certain extent in terms of some of the riskier assets, particularly the high-yield market and the stock market. So I think you really need to have a view in terms of and understand what the policy direction is. That's easier said than done because the policy in China has become a bit more, call it, unpredictable over the past few years. And this has a big impact on market performance, but also has an impact on confidence. For instance, when you look at savings rates in China, broadly, it is unusual for an economy in the stage of development of China, which is still kind of developing rather quickly, not very quickly, but rather quickly, to have a savings rate which has flatlined. And what we think is happening is that when you see that policy is slightly unpredictable, what you do as a consumer, you spend less. What you do as a company, you hoard more cash. And what that does to animal spirits is that it has a big impact in terms of animal spirits. And it requires a big signaling in terms of China policy shifts, which we don't think we will see. Now, all the investors here might be wondering what they're doing here if we were painting such a bleak picture, but the reality is we're not bearish China, we're not bullish China, we're nuanced about China. And the way that you need to invest in China is you need to kind of invest with the policy direction. And there are certain segments that we still like.
Which is not easy to forecast, you said as well. You have to be
not easy to forecast, but for instance, for us and for fixed income, China has been an alpha driver for us for the past few years. That's because there are certain segments within China, particularly with names that are systemic, names that the government is supporting in terms of economic transformation and policy transformation and so on and so forth. These are performing quite well. So you need to kind of invest in line with policy, because if you say, well, the market is cheap, the market was cheap last year, and it was cheap the year before. And this year is cheaper. And I think you need to continue. You can't really just apply the cheapness in terms of Chinese market. To be clear, we don't subscribe to the uninvestable China narrative, which is quite rampant. Actually, in a way, we like it because if a lot of investors disengage, it creates opportunities and you can pick up certain things at decent prices. But what we subscribe to is the fact that you need to understand policy direction and you need to invest in China in line with that policy. Because if you don't, you're like swimming against current, which is not a successful strategy.
Okay, thank you, Omar. We heard a lot about confidence level, also policy, which is not clear is coming in. Maybe, Carolina, can you a little bit talk more detailed on the confidence level? What means that to you? I think it's rather low. Can you elaborate on this one a bit, please?
Yeah, sure. I think the issue, our challenges, I guess, for investors for the last few years has been, because of this so-called restructuring, or what the government is wanting the more sustainable growth path for China. Sorry, the light is off here. So I think that what has happened was really during this restructuring process, the past successes have been, I guess, falling in terms of growth, including property, including also called virtual economy on the internet side. So the consumers who were hurt the most were the people living in the tier 1 cities in China or tier 2 cities. So those were the beneficiary of the past economic growth, because you get a wealth creation from property market and also you get a job creation, significant job creation in the internet and the related space. So that's why the consumer confidence, or from investor perspective, the consumer confidence is so low because that's what most investors exposed to are the tier 1, tier 2 city residents or people working in the financial industry, people working in education transportation sector, in internet sector. So the impression is like the confidence level is extremely low. But actually, when you go to, say, tier 3, tier 4 inland Chinese cities, the impact was much less in terms of negative impact. Of course, they also felt the negative impact. But because in the past, during the high growth area, they didn't benefit as much either. So this downturn to them is a lot less felt, if you like. And unfortunately, in the listed space, in the equity market, as you can imagine, all the big market cap companies or company went up the most in the past decade were the past successes. While if you want to look for instance, a consumer company benefiting from, say, consumption downgrade trend or lower tier city consumers, it's actually you have struggled to find candidates fitting into those themes. So that's why, those things will take time to appear and coming up for investors. So I think overall, I think you need to find a rebalancing point. Basically, those sectors which were damaged the most to find probably stabilize at a lower level, while the rest of the stuff actually can come up as a more replacement drivers. So this kind of rebalancing time period is certainly quite damaging in terms of both consumer confidence and the investor confidence, because you found all the past successful larger market cap company where the investor invest most of money in get damaged the most in the past few years. While you actually try to find alternative, those companies tend to be very small or hasn't really appeared in the radar screen, hasn't been listed yet. So I think that's the thing. So consumer confidence, I think, eventually will come back when the down cycle on part of the economy find a stabilization. So the hiring and income outlook start stabilizing, and then you can see the consumer confidence probably slightly improve. If anything, we feel this year we're seeing some sign of stabilization and improvement on the consumer confidence side.
Thank you. Thomas, how you look at that, and is there something related maybe also to the labor market on the confidence level in there? How do you look at that, and what gives you that from an evaluation perspective, which you work also a lot from bottom up?
Yeah.
What do you see the signals there? And if you can just talk on the labor market a bit as well, please.
So the points of Caroline are all correct. So basically what we also seeing is that like the high-end area, which are also the investment bankers, the programmers and everything, the people who can speak English most of the time, and the people who also talk to foreigners, there the sentiment is very negative. Sentiment in Hong Kong is even worse than in mainland China. So every time you actually just follow the news flow here, you think China is going to collapse. But when you actually go there, you realize it's actually not collapsing. There are challenges, but there are also quite many areas of growth. And many people actually, they subscribe to the policies, not the high-end people who got like their bonuses cut or their salary cut by 50%, but the broad population is actually not that unhappy. And in this area, also in like lower tier cities, there's a lot of growth. But from a listed company point of view, it's not always so easy to tap into this growth, but there are companies offering that. On the other hand, there are areas where China really wants to become a world leader and where they're also putting a lot of support behind their companies. And there exactly you can invest aligned with property, with government policies. One area is certainly the whole energy transition space, where many Chinese companies have become global leaders. Yes, there are some overcapacities in areas like solar, but in other areas like battery or electric vehicle, there's actually a lot of growth to be captured there because a lot of Western companies have simply missed the boat. Then again, here you might argue and say, yeah, but there will be tariffs in the US. Yes, that's correct, but the US, in terms of population, is only a very small portion of the world. And if you go to the rest of the world, Chinese companies are really taking over there. So if you go to Brazil, if you go to Indonesia, even if you go to the Middle East, you see lots of Chinese companies gaining market share from Western companies. That's why exports in China are actually holding up quite well, despite challenges coming from the EU and from the US. Related with that is also within China, Still, a lot of foreign companies have high market shares in certain areas, especially also in the industrial segment. There, Chinese companies are gaining market share from local companies. Maybe their product is not as good as a product of ABB or Schneider, but it's massively cheaper. So price for performance is still better. And in this area, actually, we see a lot of growth. So you can find companies in China which are growing 20 to 30% per year. It is not as easy as 5 years ago to find them, and some of them already might have a lofty valuation, but still there is like a lot of growth in different areas in China.
So I hear some signs for you this is really cheap, and not cheap for a reason, at least at that angle. I just want to go back a little bit on confidence, because a lot of things had happened, like with Evergrande was one of the major stories, which I would like also to hear from you, Omar, what's about that with recovery rates, etc., of the bond side. Because at the end of the day, there's two things which has happened there at Evergrande, and also a case in Hong Kong in earlier times, when at least the Prime Minister Xi Jinping made clear that international investors are not as safeguarded as domestic investors, and that have lost confidence from international investors away. Can you tell a little bit how it is as an international investor also going forward? How do you feel protected by the law and all those increments there, which I think is important also for foreign money going into China? Maybe just on the bond side. Can you elaborate here, please?
Well, you're not that protected by law.
Excuse me?
You're not that protected by law in the sense that when you invest in Chinese companies that issue bonds in hard currency, US dollar, euro, and so on, by law, you don't have recourse over the assets that are within China. And as such, for instance, we as investors, fixed income investors, typically when global fixed income investors look at things, they look at probability of default and what would be the recovery given default or loss given default. For us, we focus almost entirely, not almost actually, entirely on probability of default, and we try to avoid defaults because the way that the recovery happens in China is unclear, particularly when there are certain onshore assets. The high-yield bond market, and here we're talking about the US dollar-denominated high-yield bonds issued by China property bonds. Just to give you a sense in terms of what has been happening. Pre-2020, pre-Evergrande, the China property bonds represented about 35% of the market. So more than 1/3. Right now, they are low single digits. So this is a market that has essentially almost ceased to exist. And one of the reasons is because if you can't make an informed decision in terms of recovery, you're just not going to buy the bonds at 6 cents on the dollar or 9 cents on the dollar because you don't know if it's going to be 20. Or if you know, for instance, that you make the analysis and they have assets worth about 20 cents on the dollar, then, 7 cents. But you don't do that. So we really focus on probability of default. And we think this is a market that is challenged. I think one of the things that we probably realized earlier on is that there was a big disconnect between what the policymaker priorities are and what they're thinking, and what some investors thought that the policymakers were thinking. And that disconnect essentially led to the market in China property being essentially decimated. Having said that, I think it's very important to mention one or two things. In the high-yield segment to a certain extent, and in the investment grade to a large extent, which is a bit different actually from the equity side, the Chinese investment grade bonds actually trade very, very well. If anything, they're actually quite expensive. And this is because a lot of them tend to be somehow quasi-related or related to the government. We're talking state-owned enterprises, we're talking the Bank of China of this world, we're talking about some of the large tech and so on and so forth. So the dispersion of return within China in the fixed income market was actually very interesting. We talk a lot about dispersion in return, but we had very significant dispersion of return within the fixed income market, which presented alpha opportunities. But the short answer to your question is when you are an offshore investor in Chinese assets, our view is one needs to be singularly focused on probability of default as opposed to loss given default, because that's unclear.
Thank you. We heard from Thomas, Caroline, we heard some positive signs. Now we have seen so many difficult situations. Maybe one to address is the labor market, which you haven't before, but maybe you can there. As far as I understand, you have some unemployment problems in China, but at the same time you have some shortages of good staff in other areas. So maybe you can start with the problematic and then with the hopeful part, which a little bit definitely I think is the export industry, etc. Maybe if you can elaborate on this one, Caroline, please.
Yeah, sure. I guess as you mentioned, that the whole I guess rebalancing part basically means they want to, like it or not, I mean, the central government's agenda was to make the economy, the whole economy, more manufacturing, physical, production goods driven, basically, instead of virtualization and service driven. So I think that the whole shift basically means we have seen a quite significant expansion in manufacturing sectors, especially in the so-called high-end manufacturing side related to electronic components, new energy vehicles, solar, all those things. But I guess one of the challenging investor always pose on China is why China doesn't stimulate local consumers more to absorb the local production, given it's actually some oversupply issues in some subsectors in the manufacturing side. So the one thing I think we probably need to recognize is in a lot of those manufacturing sectors, China actually accounts for probably 20-30% of the global production capabilities. In some areas, probably even higher. But if you think about the Chinese consumer or Chinese GDP as a percentage of global, a portion, it's probably say between 15-20% or 20 plus. So it is quite impossible for China to have to stimulate consumers up by 50% to absorb all the manufacturing locally. So that's exactly why you've been seeing a quite fair bit of deflation pressure on the goods and the goods-related products in China in the last few years. The industry utilization ratio is also at a relatively low level. Then that issue has been exacerbated by the consumers being, constrained by the property downturn. So I think next area we're seeing potentially a relief of that pressure is we're hoping for more actually global upcycle. Basically means China is able to maybe have a sustainable or stronger export in certain of those so-called high-end manufacturing areas. And also stabilization of the property market probably means consumers start to redeploy some of their savings to absorb some of the manufacturing goods. Therefore, you can drag the economy out of the deflationary cycle and they'll come back into a more inflationary environment, which arguably tend to be better for the equity market as a whole, because I think the equity market really doesn't like deflation. When you say market is cheap, but if the deflation pressure persists, it's very difficult to get a re-rating because you would think the price next year is actually lower than this year. The top line earning growth will be quite constrained. So we still think the precondition for China to come back in a growth in a more inflationary environment will actually also depends on a recovery of global cycle, if you like. Of course, in terms of key growth areas, are the areas we've been discussed, really on a high-end manufacturing machinery. So basically, the two themes we're focusing on is one, Chinese company go overseas either through export or through building factories or manufacturing sites overseas, or it's a localization story in China. Basically, the Chinese manufacturer or tech companies localize and replace imports in the local markets. So those are the two themes in terms of growth we're looking for. Thank you.
I think before we open up for questions, there's one China elephant in the room, which is geopolitics. We know that Xi Jinping said that there's one nation. We all know about Taiwan. Xi Jinping is not the youngest person, and it seems to be at least what he said. He wants to see that alive, that happening. We've seen a lot of instability also global. We see that US, you told about the tariffs, etc., coming in, but still probably not such a huge problem. But maybe can you elaborate a little bit, how do you look at that, and how do you ensure your portfolio, if at all, for that kind of thinking? Thomas, please.
So on a bottom-up level, we regularly do like risk management exercising, trying to assess what is the exposure of a company to the US or to the Europe, what would happen to them if like tariffs go up or if they banned at all. So that's how we try to control it from a bottom-up level. The elephant in the room really is the Taiwan issue. So if that would go wrong, it would become extremely difficult for us as emerging market investors, but I think globally for equity investors overall. If you think this issue is going to go wrong, probably investing in equity, no matter where they're located, is the wrong thing. So that's a major risk, but the probability is still quite low because the price is extremely high for everybody involved. Eventually, they want to get rich first, China, and the West wants to stay rich. And if something would go wrong in Taiwan, that of course would all be gone within a few months or weeks. And if you look at the example of the Ukraine, there it's very painful and sad for everybody involved. So I think they're only losers there at the moment. So the West has to put in a lot of money, Russia is suffering, the local population is suffering. I think this is an example for everybody on the table that a war of like two major nations is actually extremely detrimental for everyone. And hopefully that will keep the players at bay.
Let's hope for it. Omar, is that a similar view from your company, and how do you try to immunize your portfolio against such a event?
I think the Taiwan issue is really kind of the mother of all geopolitical risks. And the reality is that it's very difficult to put in protections against that scenario. If that happens, what do you buy? Maybe not even US Treasury, maybe you buy Swiss bonds, Swiss government bonds. But it's very difficult to it's a very binary risk. To Thomas' point, we think that this is a tail risk. The probability is very low. It's not zero, but it's very, very low. I would say the geopolitics manifests itself in kind of three ways. One is the tail risk, which is Taiwan, which is obviously very significant if it happens, not only for Asia, but for the world. The second one is the separation of supply chains for certain segments. And we think that this ship has sailed and it's not reversible. And the epicenter of that is some of the, certainly the semiconductors and certain sensitive technology and pharmaceuticals and so on and so forth. When we actually looked at how much of that is happening outside of those segments, it's not a lot. I think there's a lot of headlines about the supply chain kind of being taken away from China and so on. But the reality is that it's not that significant. And frankly, for instance, a lot of people talk about Vietnam. A lot of companies that are actually outsourcing to Vietnam are actually Chinese companies, and they are investing because they're at a different stage of development and so on. And I think the third way it manifests itself is, which what you alluded to, Thomas, is the tariffs and sanctions and so on and so forth. I think the probability of that continuing to happen is high, and I think you need to integrate it into your investment thesis. And I think there's a lot of talk about the elections, the US elections, which I think will be a market mover. But the style of the two contenders is very different. Trump is stylistically different from Biden, but the substance of the policy is actually the same. As a matter of fact, none of the policies that former President Trump initiated when it comes to China have been reversed. Actually, some of them have been strengthened. So there's very strong, it's one of the very few issues that there's very strong bipartisan support for to continue to. The US calls it de-risking from China. China thinks it's containing China. But I think that also will probably continue, and you need to integrate it into your investment thesis.
Okay, thank you. And just you, Caroline, sitting in Hong Kong, how is your view on that before we open up for questions? I think because it's really the giant elephant in the room, and of course it's so hard to tell what's happening at the end of the day, but it's much more you also have to deal with it, and how does that transfer in your portfolio?
Sure. In our portfolio-wise, as the other two guests mentioned, we try to do bottom-up analysis about different scenarios, what really impact on the revenue and the earnings for the company, for instance, to try to construct a portfolio which probably minimize the damage wherever possible. But on the top-down level, I think, as I discussed with you last time, we're actually on the ground. We feel that the risk of actually China making a first move on the Taiwan issue, the risk has been actually coming down in the last couple of years. The local sentiment in terms of supporting of that seemed to have been actually coming down constantly in the last couple of years. If anything, you've been seeing Chinese government try to embrace more foreign investment, etc. So I guess also because the local economy has been suffering downturns, so therefore the local support of that is actually, has been a lot less compared to last couple of years. And also, I guess, from U.S. perspective, I think China is also probably take the view, U.S. also has a pretty, a lot of things to keep them busy at the moment as well, right? Because you got Middle East issue, you got Russian issue, and the Taiwan issue. For U.S. to run, to cope with three things at the same time, it's not easy either. To divert the financial resources and the political resources to deal with three problems at the same time. So from that angle, we also think, probably, for U.S. to make a first move on the Taiwan issue is probably also less likely, especially when there's so many other problems around. But when you get to, the presidential elections and different type of tariff and sanction, we all think, China export to the U.S. As percentage of total China export has come down a lot. It used to be like 20% of China export. Now it's actually direct export to the U.S. come down like to 13-14%. So that has dropped quite significantly. But also, as you know, a lot of them go via other countries now due to the tariff constraints. So I think that will continue. That trend is likely to continue. So when you drop to below 10%, even with tariff and various things, the impact will be much less felt this round compared to the previous round when Trump was in place. And also in business world, we found bottom up. There's a lot of ways to get around all those tariff barriers, etc. We've been seeing that in the last, 3-4 years when those tariff things were implemented. You'll find actually in the business world, there's probably 10 or 20 different ways of getting around that and get the product to the targeted countries if it's really competitive in pricing, competitive in quality. So we're less concerned about the pure tariff, issues. Of course, complete banning of, for instance, on Chinese banking access to global financial system, something like that would be quite, drastic. But I think it's very unlikely to happen. That's almost like a declaration of the war to a certain extent. So I think to that extreme, I think the likelihood remains to be relatively low. I think we just have to continue coping with it. And when the China export to the US, come down to below 10%, I think the concern will be even less.
Okay, thank you. We've seen that's a complex thing. I think we can discuss here for another many hours here. It's a nation with 1.4 billion people. And I just want to open up for questions now for the last final minutes. Is there any questions in the room?
Hello, very interesting. Can you speak about the semiconductor business, because US is blocking all the fast AI chips to China. So how long does China take to speed up the production of really fast AI chips? Because otherwise the big tech companies from the US will be everywhere. So how fast is China to build up these factories?
It's a very good question. I think China is still a few generations behind, and they are struggling to catch up. And the recent successes we've seen, for like example, chips that went into Huawei phone, that was all still done on production equipment they procured from ASML, which will be no longer possible. So that's a question I also ask myself, how long will it be to catch up? At the moment they're behind, and I think semi is really the core area where they're behind. But if you throw a lot of smart people and a lot of resources at the problem, eventually you might catch up. And don't forget, something similar might happen like in the auto space. Maybe China could never compete with combustion engines with the Germans. There was no way to catch up. But something new comes along, like electric vehicles, and China takes over the lead. And maybe in the semiconductor space, something is going to happen in the next 5 to 10 years. There are new technologies out there. I'm in no position to talk about the details here, but something similar might happen. And then the West might not have access to the leading edge technology.
So another question.
About China and Taiwan, what do you see the solution? When will it end, and when it come to a conclusion, how would it be? Thank you. Because it's the major problem.
I think the best possible solution at the moment is a status quo, so nothing happening. In the long run, eventually Taiwan is economically so dependent on China that the two will eventually move closer. It's just a question of time, and you don't know what's going to happen in 50 years. Systems on both sides might change. Populations are shrinking also on both sides. So I wouldn't say impossible, but given all the risks involved, the probability is relatively low. So, Taiwan is close to China, but it's still 40K. China has no experience in fighting a war like this, and China has lost all the wars in recent history. So has the US in Asia. So I think the US has not won a war in Asia, let's put it that way. So the stakes on both sides are extremely high, and if it goes wrong, the leadership most likely will be changed. So, and I think that's really the main hope we have, that both sides are aware of the risks that will prevent them from doing anything.
Yeah. It's also Caroline elaborated about that as well. I think that everybody's agreed, if I understand, that the costs, especially with Ukraine, etc., is seen that it's not as easy as thought, and there are so many downturns as well for them, and they have other issues to solve. But 100% guarantee, of course, is never here. And one final question.
Yes, I have a question for Caroline. How do One Belt, One Road initiatives impact domestic sectors in China? And from this point of view, what would be the most strategic sectors for China to achieve the One Belt, One Road initiatives? Because I would see a clear connection between that and an instinct from the policy government to strengthen those sectors that allows it to achieve the goals of One Belt, One Road. Thank you.
Yeah, sure. I guess One Belt Road has been ongoing for a while, and I think the progress of that was slowed down a little bit during COVID time, and it was recently see a little bit more pickup. I guess the purpose of that, from my understanding, is really you can have better influence or kind of have a more better relationship with the countries in the One Belt, One Road. They are actually trying to be a growing part of the global economy with the growth. So China is, get involved in the growth of those countries, and also they are actually, trade destinations for China. So we've been seeing China export in all the emerging markets countries, especially in the One Belt, One Road related regions, has been rising very sharply in the past few years, replacing US and Europe as the major export destinations. So we do see company in the construction companies, for instance, or the big Chinese construction company, construction material companies, and metal and mining company. So those companies probably have been, and the machinery as well. So all those related Chinese corporates have been gaining market share in those One Belt, One Road countries more aggressively. That basically means a lot of those companies now have actually, overseas revenue start turning to be 20, 30, or 40% of the company revenue, which is unprecedented in the past. So I think in terms of investment side, we do, as I mentioned, we do try to look for the candidates which was go global. So that go global does not necessarily mean developed markets, where often it actually means, the countries in the One Belt, One Road regions.
Thank you so much. With that, time is up. I think to sum up, there's a lot of challenges. We heard about the challenges. Because of the challenges, also cheaply valued or cheaper valued. But on the other hand, there's a lot of growth opportunities back in, especially in the export and industry areas, which then an active manager can position in. So with that, I thank you so much, and everybody has a great afternoon. Thank you.
Thank you.
Finally, the mandatory risk warning. The content of this episode is for general information only and is not a recommendation to buy or sell any financial products. All information is supplied without guarantee, and this is not an investment advisory.